Right now, BigBear.ai Holdings, ticker BBAI, is trading live at $5.73 per share. That's a significant intraday drop of $0.33, or about 5.45%. This price action is happening on staggering volume, with over 32.5 million shares already changing hands just a couple of hours into the New York trading session. The stock gapped down from its $5.96 open, failed to retake its high of $6.03, and has been exploring its daily low of $5.59. Now, the immediate expectation when you see a chart like that, a steep drop on massive volume, is that the company must have reported disastrous news. And if you only glanced at the headlines, you'd find exactly what you were looking for. The company's recent third-quarter report showed a 20% year-over-year decline in revenue, coming in at $33.1 million. Worse, the gross margin compressed, and adjusted EBITDA swung from a small profit last year to a negative $9.4 million loss. For many investors, perhaps those checking their accounts on the Robinhood app or SoFi Invest, this is an immediate red flag. It confirms the prevailing narrative that BBAI is just another cash-burning, overhyped AI name, a stock that's all promise and no profit, a world away from the proven performance of a company like Apple stock. But the reality of what is happening today is infinitely more complex and, frankly, more fascinating. Today's trading isn't a simple reaction to that earnings report. It is a full-scale battlefield. It is a violent repositioning of capital as the market attempts to price in a move so significant it essentially changes what the company is. While the market was digesting that 20% revenue drop, BigBear.ai also announced it is spending $250 million in a definitive agreement to acquire Ask Sage, a platform for secure agentic AI. This isn't just a small bolt-on, this is a massive company-altering bet. To put it in perspective, BigBear is paying a 10 times multiple on Ask Sage's projected 2025 annual recurring revenue of $25 million. This is a steep price, and they are paying it precisely because their core business, as reflected in the Q3 numbers, is facing headwinds from delays in certain Army programs. So the tension is clear. The bears see a company with declining revenue and shrinking margins lighting $250 million on fire. The bulls, however, see a company with a massive cash pile of over $400 million, using that capital to buy a critical missing piece, a secured FedRAMP-accredited AI platform and its founder, who will now become BigBear's Chief Technology Officer. This is the entire story. The market is fighting over two completely different theses. The expectation thesis, based on the Q3 numbers, is that the company is failing. The reality thesis, based on the acquisition, is that the company is executing a hard pivot to become a premier integrated AI platform for the defense and intelligence community. The 32 million shares traded so far today, that's not just retail panic, that's a massive exchange of ownership, with investors who believed in the old story selling their shares to a new class of investors who are buying into the new one. This isn't a stock for a passive set-it-and-forget-it plan like Schwab Intelligent Portfolios. This is a highly speculative, active management asset. You would be watching this on your Fidelity trading platform or an advanced system like Interactive Brokers, not tucking it into Fidelity IRAs and forgetting about it. The volatility here is extreme, with a 52-week range that stretches from $1.70 all the way to $10.36. This kind of movement makes even Tesla stock look predictable by comparison. The people trading this aren't looking for investment help, they are executing a very specific high-risk thesis. Let's look deeper at what the bulls are seeing, because that's what the 13F filings were telling us even before this news. In the most recent reporting period, we saw a massive influx of institutional capital. The Vanguard Group increased its stake by over 32%. BlackRock added 18% to its position. Citadel Advisors, one of the most sophisticated funds in the world, boosted its stake by an incredible 420%. Charles Schwab Investment Management, which runs many Fidelity ETFs and other funds, upped its holding by 275%. What did they see? They saw a mini-Palantir narrative. They saw a company with deep ties to the U.S. intelligence community and Department of Defense trading at a fraction of Palantir's valuation. BBAI sits at around 11.8 times forward sales, while Palantir commands a 79 times multiple. These institutions weren't buying BBAI for its commercial business. They were buying it for its government contracts, its security clearances, and its potential to capture a slice of the generational spending on AI for defense. The Ask Sage acquisition is a direct confirmation of that thesis. BBAI isn't trying to compete with NVIDIA stock on hardware, it's trying to compete with Palantir on integrated, secure software for a very specific, high-value client, the U.S. government. So what does BigBear.ai actually do, and how does this new piece fit? At its core, BBAI provides AI-powered decision intelligence. They build models for predictive analytics, supply chain management, and autonomous systems. Their customers are primarily in the defense sector, the intelligence community, and to a lesser extent, commercial logistics. Their technology is used for things like modeling, simulation, and battlefield orchestration. The problem, as seen in Q3, is that this is a lumpy business. It relies on massive, slow-moving government contracts. If one program is delayed, it creates a huge hole in the quarterly revenue. The Ask Sage acquisition is an attempt to fix this. It provides a platform-level, recurring revenue product that can be sold across all of its clients. It's built for secure, regulated environments. It allows organizations to deploy and manage various AI models safely. This is what the market has been demanding. It's a move from being a services and consulting company to being a true platform company, which commands much higher valuation multiples. The recent price action tells this story of conflict perfectly. The stock has fallen over 33% in the last month as fears about the Q3 earnings grew. But over the last year, it's still up over 220%. Reflecting the broader excitement for AI and the mini-Palantir narrative. Today's drop is the market trying to find an equilibrium between these two powerful forces. Analysts' opinions are just as divided. Kantar Financial, for example, saw this dual announcement and raised its price target to $7, maintaining an overweight rating. They are clearly buying into the strategic pivot thesis. They believe the acquisition is the key to unlocking long-term growth and justifies looking past the ugly Q3 report. Other analysts, however, have downgraded the stock in recent months, pointing to the revenue and margin concerns that Q3 confirmed. This creates a confusing picture for anyone doing basic online investing or looking at a simple summary on their SoFi Invest app. The data seems to point in both directions at once. This is where the real work of self-investing comes in. You have to decide which narrative you believe. The future outlook for BigBear.ai has now split into two very distinct scenarios. In the bull case scenario, the Ask Sage integration is a massive success. The new TTO, the founder of Ask Sage, energizes the company's tech stack. BBAI successfully cross-sells this new secure AI platform to its existing defense and intelligence clients, generating that sticky $25 million in ARR and growing it rapidly. The lumpy services revenue becomes less important as the high-margin platform revenue takes over. The Palantir valuation gap narrative gains traction and the stock re-rates significantly higher, making Kantar's $7 target look like a stepping stone. This is the future the institutions were betting on. Then there is the bear case scenario. In this version, BigBear.ai massively overpaid. A 10 times multiple on projected revenue for a small company is seen as a desperate, value-destroying gamble. The integration proves difficult, the new platform fails to gain traction against incumbents, and the core business continues to struggle with declining revenue from its Army contracts. The $400 million cash pile, once seen as a strength, begins to dwindle as the company burns cash on both its legacy business and the new acquisition. In this scenario, the stock breaks below its recent technical support levels, and the institutions that bought in decide to cut their losses, leading to even more selling pressure. The stock becomes a cautionary tale of a company that tried to buy its way out of trouble and failed. The sheer volume we are seeing suggests that both of these scenarios are considered highly plausible. This is not a stock for the faint of heart. This is a stock for an individual brokerage account managed by someone who has done the deep research and has a strong conviction. This isn't something you buy using a Fidelity mobile app while waiting for coffee. This is a high-stakes bet on strategy and execution. As an investor, you have to weigh the expectation of failure